You ever have really good plans to make something work, and then all of a sudden something comes out of left field and ruins your plans? Well, this is what happened to me when I was trading the Aussie yen. This was after the GFC. So you can see this is the GFC. This is the Aussie yen, by the way, daily chart. And what you're looking at here is the complete collapse that happened during the GFC there, which is basically, it was August, September 2008. It actually bottomed out in October, but August, September. An interesting thing is most people forget that in August of 2007, we had a very similar crazy time. Actually, July and August of 2000. Well, I remember because I was snowboarding in New Zealand at the time, and I remember checking the charts at night after snowboarding all day and going, holy crap, like the markets were just taking off, and I wasn't really watching them at the time. But then a year later, boom, it happened again. So what we were doing, my friends and I, is we were taking, and by the way, if you want to see how you can use some of the principles we're talking about here to grow a small account quickly, we're taking $1,000 account. We're going to ramp it up to 100,000 over 300 trades. And you can learn more at bigprofitscourse.com if you'd like to learn about how that works. And you can join us and see how it works for yourself. So we were trading the Aussie yen. And what we're using is, you may have heard of these before, but it's like a grid style system. The way a grid style system works is, I'll zoom in so you can see here. Basically, you take a whole bunch of trades, and you take them. You usually have a bias. You don't have to, but oftentimes you have a bias, like you only buy or you only sell, for example. And you have all these trades that are stacked up like this. You have all these orders on your chart, and your chart just looks crazy. Usually, you use a lower time frame too, so that what happens is, as the market goes and clicks into your trades here, like let's say we have all these orders right here, the market's down here, and I know this is the daily, and we'd be looking at like the 15-minute or the 30-minute or something like that, or the hour chart. We wouldn't be looking at the daily when we did this, but it would go up, it would click into some of your orders, and as soon as it went to the next level, it would click in a new order, but it would start cashing them out. So, for example, what we were running was a 5-pip grid, which is super intense, very crazy, really. But it can make you a whole boatload of money, especially if you have a bias. Now, we knew at the time that the pound yen had basically collapsed with the GFC, and so, and everything really collapsed, right? I mean, there was volatility across the board, but what we knew is that the best interest rate differential was on the Aussie yen. So that's why we went with the Aussie yen. And we were taking these trades every 5 pips, literally every 5 pips. And when the market would move 5 pips in my favor, it would cash out. So every 5 pips, it would take a trade, and 5 pips later, and when it went up 5 pips, it would dump the last trade. Okay, and when the market came back down, it would refresh the orders. So you can imagine how many trades you take. They're really small trades, so they weren't very big. But what's interesting about this, when you think about it, you're always going to be caught with a few trades. So when the market comes up, for example, let's say, let's say you're trading up here. So we've got our orders up here. And this is always going to be the case with this style of trading, by the way. So we have some orders up here, and they're all stacked up, right? And then what happens? The market comes up, it spikes into them, and remember, you have to cover the spread too. You have to cover the 5 pips plus the spread. So what ends up happening is you always get caught with a couple of these trades, and then the market goes against you. And it really sucks, because at the top of these turning points, when you're bullish, like we were in this case, you end up with some trades underwater. And the question is, what do you do with those? And what we had decided to do was to buy options. And that way, these options that we had to take every so often to cover our downside risk would basically offset. I mean, they didn't completely offset, but they had essentially offset the risk that we were taking by using this grid system. Okay, so why am I telling you this story? Because I want to drive home a lesson, and I think and I'll put it in the notes for this video. Below this video, there'll be another link, and you can see another video there I think you should definitely check it out because it's eye-opening if you've never seen what is possible for brokers to do. But what started happening is what I've seen happen multiple times. And I'm not saying I'm not saying this because I'm saying, oh, it's a scam or whatever. Brokers are a scam. I don't fault anyone on this. Okay, this is just the way that the rules were at the time. The rules have changed a bit, but the way that the game was set up was the brokers. And by the way, I've never seen this not to be the case. So if anyone can raise their hand and say, yes, I'm trading for profits, and no, I'm seeing no slippage whatsoever with my trades, let me know in the comments because I want to know who your broker is. Because we've tested this across the board. I've tested it with multiple accounts at the same broker. And as soon as the broker identifies your account as an A account. So there's A traders and B traders. B traders don't make money. Broker isn't concerned really with you unless you have a big account. But even then, they're not really concerned with you when they see you as a losing trader and you've proven that. If you make money, however, or if you have a large account, they're going to make sure that they hedge your positions in the real Forex market because they don't want you to put their company out of business essentially. And once they see that you're making money, they're going to slip you. And so what that turns out in a system like this is it basically makes it unsustainable. You can't. You're not going to be able to trade this when that happens, and I'll show you why. Remember what I said that we were taking a trade every 5 pips, and then once the market went 5 pips, we'd get out. So we're making these little 5-pip trades all the time, little tiny ones. But the market would go up, cash us out, pull back. We'd refresh the orders, it'd come back up, and it was great. And the only time that it was really bad is when the market would turn hard against us, and like it did here, for example. And then we would have to sell our options that we were buying, and or execute basically. But really, we were selling them. So what was interesting about this was how they did it, and this is how they always do it. I use buy stops and sell stops, and they'll slip me when I get into my buy stops and sell stops. Why? Because they're taking away profit. Assuming that that's a winning trade, if they slip you getting into your trade, what does that do? It reduces your overall profit. Now, when we're talking about 5 pips of profit and they start slipping you by 1.5 pips, guess what? That's 30% of my profit. It's magically vanished. So that's what was happening. And not only that, but because they were slipping us, it was harder also for us to get out of our trades. So we were getting in late and we weren't necessarily getting out. So what that meant is when we had these turning points, instead of being holding like 2 or 3 positions, we'd have more, 4 or 5. And what they were doing was essentially forcing our hand and making us want to get out. And that's what we did. We stopped it. We stopped grid trading. So there's a couple of principles that I like to share with you because I think these are useful if you are going to trade currencies, and if you are using a system that makes money or an approach that makes money with multiple systems or whatever it is. In the big profits course, we actually trade multiple strategies. And I'm show you my videos when I take the trades and all that. So what I'll tell you is these are the things you can do to make sure that the slippage doesn't hurt. One is trade higher time frames. If you trade a higher time frame, so because we were trading for 5 pip profit, the slippage on the entry and the slippage on the exit was really hurting us. They made it difficult. The market really had to go hard in our favor from the finally cash us out. And when the market pushed through our price, our buy stops, they were actually slipping us on entry. And they knew exactly what they were doing. And it was probably automated, as you'll see if you look at the link down below this video. So, and that's fine. I mean, that was the way that the game was played. So by trading higher time frames, instead of going for 5 pips, what if I go for 500 pips? Okay, so they slipped me a pip and a half on 500 pips. What does that matter? Well, not much at all. Even if I'm just going for 100 pips, if they slip me a pip and a half, I'm losing 1.5% of my profit if that hits the target. Now, of course, they could slip me on the exit too. But typically, it's easier for them to slip you on the entry. Now, instead of losing 30% of my profits, I lose only 1.5%. If I have a 200 pip target, I only lose 0.75% and so forth. So the easiest way to get around this is to trade the higher time frame. And that if you're concerned about slippage and you've seen this as I have, the easiest way to get around this is to trade a higher time frame. The second thing that you can do is you can hide your orders. So there are things like you can Google Pecunia Systems, and they have a software that'll enable you to hide your orders. There are lots of other ones out there where you actually there was one actually I remember from like way back in 2007 where you could put your orders in the software, and then the software will push it through as a market order. Now, this is good if you're worried about the broker shenanigans when it comes to your exit. However, you have to keep in mind that the way that your platform is going to see these orders is they're going to see them as market orders. So, if it's a fast-moving market, you still might have some of the same problems. The only thing that's going to help is to hide from your broker what you're doing. If you're concerned that your broker sees where your stop is, for example, and then goes ahead and spikes the price toward your stop. Again, if I'm trading higher time frames, is that really an issue? Not really, because my stop is going to be so darn far away. If I'm trading the 5-minute charts and my stop is 10 pips away, it's really easy for the broker shenanigans to kick in and they spike me out, and boom, there's another loss that I have to account for. But if I'm trading the 8-hour chart and my stop loss is 185 pips away, it's not going to be that easy for the broker to say that, oh, low liquidity, blah, blah, blah. I'm sorry about that. So that's another thing to keep in mind, is that trading higher time frames means not only are you going to go for larger targets, but you're also going to have your stop much, much further away. And so slippage and your percentage loss on gaps and slip stops is not going to be nearly as much as it would be if you're trading a lower time frame. When you're trading the lower time frame, people will say, "Oh, well, I don't have any overnight risk, or I'm not holding my trades over the weekend, or whatever." That's all true. But if you have if the market's running right now and you have a 10 pip stop, what happens if the market gaps 30 pips against you? You've just lost 3 times your risk if you can get out. So, it's definitely not for everyone trading the lower time frames. And the last thing really is to get away from the charts. The best decisions I've ever made is when I am not sitting watching the charts like a hawk. And the reason why is there's actually a thing called fixed ratio interval reinforcement. And what that means is gambling. So gambling is random ratio reinforcement. Random interval reinforcement is when sometimes you get reinforced, you win, and sometimes you don't. That is the most addictive of all. And so if you're sitting around trading the 5-minute charts, getting these immediate hits and highs and dopamine hit in your reptilian brain, essentially, from taking these trades, that's a highly addictive and a very difficult thing to break. If, however, you're trading the 12-hour charts, you put your trade in, you walk away, and you come back and check the charts maybe 6, 7, 8 hours later, the next day, the day after that, you are now in your frontal lobes. You're planning your trade out. Just like someone would plan out building a bridge or baking a cake or writing a book or whatever. You're planning, so you're no longer reacting. And so that's why I recommend that if you're worried about broker shenanigans, and again, you can click the link below this video to learn more about broker shenanigans, or you've seen this slippage kick in as soon as you start making money, it's a bit discouraging, then certainly that's something that you might want to do. Trade the higher time frames, hide your orders, and get away from the gambling mindset. Instead, start working from your, start trading from your frontal lobes. It's a really, really good place to be. It also, you won't burn out. You'll be much more likely to burn out if you're trading the higher time frames, especially if you have a job. You're working all day, come home, sit in front of the charts for 5 hours. It's not a good life. I mean, trading is supposed to enable you to have freedom. There's a lot of hard work. It's difficult. It's not cut out. Most people aren't cut out for it. But certainly once you nail it, you might as well milk it for all you can. And one of the best ways to do that is just put your trades in, walk away. Some of my best trades have been the ones that I've done the minimal amount of management. And we talk about this in the Small Accounts, Big Profits course too, where, setting up your trade so that the exit is automated. So you're not a part of that decision. It can really help. So I hope this helps. I wish you happy trading, and we'll see you in another video.